Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In the previous part, we looked at one of the most basic intraday setups, the Opening Range Breakout or ORB. We covered what it is, where it came from, and then tested a few simple hypotheses to see which opening range time window seems to work best on Nifty. Now, those tests were done on the spot index mainly to get a clean, high-level sense of the underlying's behavior and confirm whether the ORB idea shows any promise at all. Today, I want to make it practical. Instead of spot, we'll look at how to trade ORB in India using the most liquid instrument we have, NIFTY options. Both buying options and by selling them, and see how each approach fares. Without further ado, let's get started. Disclaimers first. The examples and ideas shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in complete loss of capital. The examples and data presented are meant to explain market behavior, not to suggest that similar outcomes will occur in the future. Also, a basic understanding of options and derivatives is assumed to fully understand the concepts discussed in this episode. With the disclaimers out of the way, let's get started. In this episode, I would try to use inputs from the previous backtest that we did on Nifty Spot and build two different ORB strategies, one for option buying and one for option selling. Now remember, since we are using weekly options and not synthetics, this is not an apple-to-apple conversion. This is more of a red apple to green apple kind of conversion. Sorry, that was a bad joke. On second thoughts, I think that was a good analogy though. Anyways, back to ORB with options. Like any ORB setup, we need a few parameters. The first is the opening range window. Based on the spot test from the previous episode, we found the most reliable window to be 9:15 to 11:15, so we keep that constant. Now the important part. How do things change when we move from spot to options? Let's start with the option buying version. When I say option buying, I mean ORB on option premium, not on spot value. Just to make it clear, here we don't trade ORB on the index. We trade it on the option premium itself. And yes, to keep the stop loss and risk management simple, we'll use a fixed premium selection. It's not perfect, but it's simple and intuitive. So here's how it'll work. At 9:16, we select a strike whose premium is closest to 200 rupees, separately for C and P. Then we track them till 11:15 close. After that window of time, we form a reference range for that option premium, say a high of around 250 and a low of around 180. If the premium closes above the range, example above 250, that triggers a long trade. We buy that option at the prevailing premium at that time, maybe at around 250. The same logic applies independently to the call and the put. We take at most 2 trades per day, one C and one P breakout, if triggered that is. Each trade has a 20% stop loss on the entry premium. Example, if we buy at 250 and the stop loss is at 20% of 250, that is 50 rupees, so the stop loss would sit at 200. Now why track a 200 rupee premium strike instead of say 100? My thinking is simple. On weekly options, a 200 premium strike is usually closer to in the money or already in the money across DTs. And that matters for long options because ITM-ish options tend to have higher delta and lower theta compared to ATMs and OTMs. In other words, it allows for playing the direction better, and with ORB, it's all about direction. Of course, you can test other premium levels as well, 100, 150, 250 and compare results. You can also test across different DTE buckets and see if the behavior changes. In this backtest, I am not showing DTE-wise optimization because that can become curve fitting, but if you find something structurally consistent, for instance, if you see one DTE almost never works, you can treat that as a filter and either skip that DTE or design a different logic for that day. A few other backtest related assumptions. For the option buying approach, we are keeping a margin of 1.5 lakh per lot. In a day, there will be just one trade. So I'm testing with 5 lots. So that would mean 7.5 lakh capital for 5 lots. Also, the backtest is post brokerage and taxes, and the slippage of 0.2% has been applied. The test period is Jan 2022 to present, that is Feb 2026. With all those details done, let's get started with the equity curve of the option buying strategy. As you can see, the strategy has a smooth curve till about Jan 2024, and then it got bumpy. If you look at it, it still has not come out of the drawdown that started in mid 2024. But I still won't dump it. It does seem to have some potential. Let's now look at the year and month-wise returns. 2022 to 2024 were not bad. Then 2025 seems as bad as it was for so many other strategies. 2026 so far is not bad again. Seems intraday trends are back. Let's see how it continues. Next is the performance metrics for the options buying strategy. All the values here are in percentage, so when you read it, you will have to look at it as a percentage of 7.5 lakh base, which I use for testing this on 5 lots. Now on the performance front, if you look at the win rate of 48% for an option buying strategy is not bad at all. Buying is very much like trend following, where the returns are known to be bumpy. A few large trades have to pay for many small losses. But one has to look at the max drawdown figures as well. How many of us can sustain a close to 45% drawdown? And what if it's more? This is where position sizing becomes key. We may have to increase margins to reduce the impact of the drawdowns, the way I explained in the position sizing episode. Now let's look at the equity curves separately for both call and put buys. This chart is super fascinating for me, and I'll tell you why. You see, if you follow the concept of overnight effect, something that I have spoken in detail in one of the previous episodes, on an average, we should have puts making more money than calls and puts winning more than calls. But if you look at the data, that doesn't seem to be the case, at least for this RBO buy strategy. Both are winning almost equally, and yes, the period between May 2024 and May 2025 has been bad for both. And in general, puts seem to be more volatile than calls, as seen clearly in the drawdown curve. But still, very interesting. With the option buying version done, let's now shift our focus to the option selling version. Now, when we sell or write options, we would need to look at margins differently compared to buying. That's because there are fixed margin requirements for option selling. So from a margin standpoint, I'm going to assume that we would need 3.5 lakhs per lot, and unlike option buying, it's quite possible in option selling that we have 2 parallelly running trades. So for a day, we may need 7 lakh per lot, and if we do 5 lots, that would mean 35 lakhs of margin. The rest of the rules don't change. We use the same range reference, that is 915 to 1115. The strike selection logic also remains the same. That is tracking premiums closest to rupees 200. Just the way I had explained that in buying, our entry may happen at a premium greater than 200. In selling, our entry may happen at a premium much lower than 200. For example, a 200 call strike tracked at 916 makes a high of 250 and a low of 180 by 1115. If it breaks 180, we short the call, and the same logic applies to the put side as well. Now, if you have traded options, you would know that sometimes both the call and the put can continue to lose their value, and they may together keep breaking their lows during the day. On such days, we may have 2 entries, and hence a margin of 7 lakh was considered to accommodate both the legs. And just the way we do it in the option buying version, we maintain a 20% stop loss for each of the legs here. And this backtest again is post-brokerage and taxes, and a slippage of 0.2% has been applied. The test period is the same, Jan 2022 to present Feb 2026. So with that, let's get started by looking at the equity and the drawdown chart for the option selling version. As expected, much smoother compared to option buying, except for large drawdowns in 2025, which was a bad year. Over to year and month-wise returns. All years in the dataset are in green and great consistency even when you look at it from a monthly P&L standpoint. Obviously, since this is option selling, it comes with its own advantages. Next is the performance metrics for the option selling strategy. All the values here are in percentage, so when you read it, you have to look at it as a percentage of 35 lakh base, which I use for testing this on 5 lots. Surprisingly, only a minor improvement in win rate for option selling. I expected it to be way better. The returns are okay, nothing out of the ordinary, but look at the max drawdown value, just about 6%. Also, given that you can use your pledged underlying to sell options, directional option selling of this sort is worth exploring. I'm not saying this exact setup is worth trading. Maybe it's worth looking at DTY split as well, especially for option selling. Like we did in option buying, let's look at which side performs better in option selling. Now, just to reiterate, when we sell calls, we are short in terms of direction, and when we sell puts, we are long in terms of direction. Now, if you look at this chart, again surprising because I expected P's to perform better as they are generally priced higher. But like option buying, where buying calls offered a smooth curve, even here, selling calls offer a smoother equity curve compared to selling puts. So if I have to put it all together, what we did was to apply the ORB idea to a tradable instrument like NIFTY options, and we did that in two ways: buying options versus selling options. As you would have noticed, both approaches have a positive expectancy, though the overall returns and drawdowns would differ. Option selling generally offers a more smoother return profile than option buying. Also, surprisingly, to me at least, trading just calls on either side, buying or selling, seems to be less volatile than trading puts. Why is that the case? Option geeks among us may know. Do comment and let me know your thoughts. So that brings me to the end of this part 2 on opening range breakouts. Though I just applied this logic to NIFTY, it may work on many other indexes and products as well. Something I will explore not immediately, but in some point in future for sure. I hope you found this episode useful and interesting. Do share your questions, thoughts and feedback in the comments. I'll do my best to respond. Thank you for watching and see you in the next one.